In the market, my friends, nothing ever happens by accident. Every surge, every retreat, every quiet pause in the tape is a message. And today, as we gather around the chart together, I want to talk to you about something many traders sense but few interpret correctly, the growing signs of a stock market bubble. And as we move into this discussion, you'll notice how naturally it ties into the previous video on the real Wyckoff signal traders always miss, stop buying early, because missing the true turning points is exactly what gets traders caught when a bubble starts to deflate. Now let's speak plainly. When I look across the broad market today, I see the same emotional fingerprints I've studied for decades. The public becomes euphoric. The news spreads stories of endless prosperity. Stocks begin rising not because of sound accumulation, but because everyone assumes the next buyer will pay more. Have you ever caught yourself thinking that way, hoping someone down the line will bail you out at a higher price? If so, you'll understand exactly why bubbles form and why they eventually burst. Bloomberg's recent warnings about a potential crash echo many of the telltale Wyckoff principles. A market does not collapse from strength. It collapses from weakness masked as strength. And if you've trained your eye to detect distribution, you'll recognize how the composite operator, those deep, pocketed hands guiding the market, quietly unloads shares while the public grows more frantic to buy. Look closely at the volume on the rallies. Look at the shortening thrusts. Look at the hesitations near the highs. Doesn't it feel like effort is beginning to exceed the result? That imbalance is the whisper before the storm. And while equities wobble, something else stirs the commodities. Oil, copper, uranium, natural gas. These markets behave differently than the tech darlings dominating the headlines. Commodities are governed by real supply, real demand, real scarcity. When stocks begin frothing in a bubble, like environment, commodities often telegraph the truth earlier, because there's no narrative strong enough to override raw supply constraints. Have you noticed how commodities often turn long before equities? It's one of the reasons I always tell traders to study these markets. They reveal the underlying pressures building beneath the surface. As Bloomberg points out, the commodity sector is flashing signals that should make every trader sit up straight. A tightening supply chain, geopolitical tension, and uneven inventory levels can set the stage for dramatic repricing. But remember, dramatic repricing doesn't always mean higher. In a deflationary unwind, commodities can fall sharply before bottoming into new accumulation phases. Are you watching those phases carefully, or do you only react when prices explode on the chart? Successful traders, Wyckoff traders, anticipate. They don't chase. This ties directly to something we explored in that earlier video on the Wyckoff signal traders always miss. Back then, we talked about how premature buying cuts traders off from the true cause forming beneath the surface. Today, we're seeing the same psychology play out on a massive scale. Many are rushing into late stage markup without asking whether the cause supports the effect. They buy because price is high, not because the composite operator is accumulating. Think about that for a moment. Isn't that the exact mindset that gets people trapped at tops? When we study bubbles, we're not studying hysteria. We're studying human nature. Every bubble begins with quiet accumulation by professionals, then transitions into public participation, then spirals into mania as the latecomers scramble for scraps. You can spot the shift in tone. In early stages, people talk about risk. In the late stages, they talk only about reward. Have you heard that kind of chatter lately? When the crowd stops evaluating risk, that's when the smart money begins to sell. This is why I always push traders, especially new ones, to look beyond the stock price and into the structure. The structure tells the truth. If a market is distributing, you'll see upthrusts, failed rallies, lower volume support tests, and that subtle but sinister inability to push meaningfully above resistance. The composite operator is skilled at creating the illusion of strength during distribution. He wants you eager, confident, maybe even careless. A careless trader is easy to sell to. Would you consider yourself careful or careless in these conditions? It's a question worth asking. Now think about commodities again. While equities might be entering late stage distribution, certain commodities might already be building new causes. Some may be forming long basing structures, others may be completing shakeouts. When you look at these charts, do you see the footprints of accumulation? Or do you see weakness that's not yet finished unfolding? The beauty of Wyckoff analysis is that you don't need predictions. You just need to read the story the chart is already telling you. Wealth, in trading, doesn't come from predicting tops or bottoms. It comes from aligning yourself with the composite operator and avoiding battles you can't win. So when Doomberg sounds the alarm on a possible crash, I don't want you to panic. Panic is the enemy of preparation. Instead, I want you to step back and read the market like a seasoned operator. Where is the real demand? Where is the real supply? Where is the real cause being built? And perhaps more importantly, where is the herd emotionally positioning itself right now? Remember how in that earlier video, we talked about resisting the urge to buy too early. Today's market is testing that discipline again, but in reverse. Instead of buying too early, many are holding too long. The psychology is identical. The result is identical. The antidote is identical: patience, observation, and respect for the tape. As we look layer by layer at the current environment, I want you to question your assumptions. Are you buying because the chart shows genuine strength, or because the narrative feels comfortable? Are you ignoring warning signs because the trend has lasted so long you assume it must continue? The market rewards clarity of thought and punishes emotional conviction. The composite operator counts on your emotions. Don't give him that advantage. And when you analyze the commodity sector in contrast, notice how these markets often shift sentiment before the broader indices do. Commodities can offer clues, subtle ones, but powerful if you know how to read them. Sometimes strength in commodities signals inflationary stress that equities aren't pricing in yet. Sometimes weakness signals demand destruction that will ripple outward. Rising equity prices are showing classic late stage bubble characteristics, and to understand what that really means, we need to slow down and look beneath the surface of the market's recent behavior. When prices rise rapidly over an extended period, traders often assume strength is the explanation. But seasoned chart readers know that strength and height are not the same thing. A market can reach lofty prices even while its internal condition weakens dramatically. And that difference is where most traders get blindsided. A late stage bubble doesn't reveal itself through one single signal. It reveals itself through an accumulation of subtle distortions in price, volume, sentiment, and behavior. One of the first signs you often see is a shift in how the public participates. Early in a trend, participation is cautious. Traders ask questions, look for confirmation, and worry about risk. But as prices continue higher, doubt fades and excitement takes its place. People start buying because everyone else is buying, assuming the momentum itself is a guarantee. When have you last seen traders making decisions simply because it keeps going up? That mindset marks the early emotional fuel of a bubble. Another hallmark of a late stage bubble is the detachment between price and underlying cause. In Wyckoff terms, every strong trend needs a cause, a foundation of accumulation, institutional sponsorship, and genuine demand. But as a bubble matures, the cause is no longer expanding. The markup continues, not because professionals are supporting the market, but because public enthusiasm takes over the role of pushing prices. This creates rallies with weak sponsorship, fast upward movements with thin volume or volume spikes that come from retail rather than institutional flows. Look closely at a chart during these moments. You may notice how rallies become shorter-lived or how each push upward requires noticeably more effort. Have you ever wondered why a market needs more and more volume just to make smaller and smaller gains? That's the imbalance that reveals the truth. Late stage bubbles also show strain through failed rotations. In a healthy bull market, money rotates smoothly between sectors. When one group pauses, another takes the lead, keeping the overall trend balanced. But in a bubble phase, leadership narrows. Instead of broad participation, only a handful of heavily hyped names drive the indices. This creates the illusion of strength while the underlying breadth weakens. Imagine watching the market rise while most stocks quietly drift sideways or down. If you've seen that lately, you're seeing a classic bubble signature. Another critical characteristic is the emergence of parabolic patterns. Price begins rising at a pace that defies fundamentals, moving almost vertically on the chart. Parabolic trends are inherently unstable because they rely on uninterrupted optimism. They leave no healthy consolidation zones, no areas where strong hands take in supply. Without those pauses, there is no structural support beneath the market. When a correction finally arrives, it tends to be sharp and unforgiving. Think about how many charts you've seen recently where candles stretch longer, where intraday swings widen, where volatility increases even as price moves higher. These are signs of emotional buying, not rational accumulation. Sentiment indicators during late stage bubbles become exaggerated. You'll notice analysts raising price targets simply because price kept rising, not because earnings or demand justified the projection. News headlines lean heavily bullish. Social media feeds overflow with declarations that the market can only go higher. People who rarely trade become suddenly interested, often bragging about gains without understanding the risks. When optimism becomes the dominant emotion and skepticism disappears, that imbalance itself becomes a warning. Have you noticed how difficult it becomes to find a bearish argument during these phases? The absence of doubt is often the loudest alarm. Volume behavior also shifts. Instead of seeing strong volume on rallies and lighter volume on pullbacks, which is characteristic of healthy uptrends, you begin seeing the opposite. Rallies occur on lighter volume, while down days suddenly show spikes. That tells you who is acting. The professionals are no longer supporting the markup. Instead, they are using the rallies to distribute quietly. Meanwhile, the public is the one buying on light volume, unaware they are absorbing shares the composite operator is eager to unload. This discrepancy between who is buying and who is selling reveals a tremendous amount about the market's true health. Another major sign is the increasing reliance on narratives instead of data. As a bubble matures, stories become more powerful than earnings. Traders convince themselves that certain sectors are unstoppable, or that certain companies are immune to valuation limits. The psychological environment becomes so strong that rational analysis fades. When the story becomes larger than the numbers, the bubble enters its most fragile phase. Think back to recent discussions you've heard. Were they based on present value, or on what someone hopes will happen? That distinction often separates disciplined traders from emotional participants. A late-stage bubble also introduces greater intraday instability. While prices still appear strong on a daily chart, the intraday action shows cracks. Sudden reversals, strange spikes in volume, failed breakouts, and sharp sell-offs that quickly recover all point to a tug of war beneath the surface. These anomalies are the footprints of large players repositioning. If you're watching closely, the tape begins to feel heavy, even though the chart still looks bullish. And finally, the most defining characteristic is confidence. Too much confidence. Confidence so strong that traders no longer fear downside. Confidence that dismisses corrections as buy the dip, opportunities without analysis. Confidence that assumes nothing can interrupt the trend. But markets punish overconfidence, especially when elevated prices are no longer supported by genuine demand. As these characteristics collect across the market, rising equity prices stop being a sign of strength and instead become a sign of imbalance, fragility, and excessive enthusiasm built on weakening foundations. Effort-vs result imbalance is tightening across major stock indices, and if you've studied market behavior for any length of time, you know this dynamic is one of the clearest early warnings a Wyckoff trader can detect. Markets communicate through the relationship between effort, usually seen through volume or volatility, and the result, which is expressed in price movement. When the two no longer align, something beneath the surface has shifted. And whenever effort starts rising while the result shrinks, you're looking at a market that is becoming strained, exhausted, or manipulated by stronger hands. To understand why this matters, imagine watching a rally that once moved easily, almost effortlessly, with smooth price progress on modest volume. That's what real demand looks like. But now picture that same market a few months later. The candles are taller, the volume is heavier, the intraday swings more violent, but the actual distance traveled upward is shrinking. Have you ever noticed a chart that works harder just to go nowhere? That is effort vs. result imbalance in its purest form. This imbalance tells you the composite operator is no longer driving the advance with conviction. Instead, public buyers are often the ones pushing effort higher, while professionals are quietly supplying stock into that enthusiasm. When pros distribute and the public buys, you get markets that look active, even exciting, but not sustainably strong. Under this imbalance, every rally becomes more fragile than the last. One of the most striking signs is increased volume on smaller price bars. You may see a huge surge in trading activity, yet the candle closes only slightly above or sometimes even below the open. Many new traders view heavy volume as strength, but experienced chart readers ask a more important question. If so much effort showed up, why didn't price move farther? That question alone can save a trader from chasing tops. Price that fails to respond proportionally to effort reveals hidden resistance. The selling pressure of the composite operator. Another expression of effort result imbalance appears during breakouts. In healthy markets, breakouts require moderate effort and deliver strong follow-through. They push through resistance, attract new demand, and run cleanly. But late in a trend, you begin seeing breakouts that require massive volume only to travel a small distance before stalling. Sometimes they even reverse quickly, trapping eager buyers. Think of the last time you saw a breakout that looked powerful for one day, maybe two, and then rolled back under the breakout level. Did the effort match the result? Or was the market telling you something deeper? This pattern also appears in pullbacks. In earlier stages of a trend, pullbacks usually show lighter volume and smaller ranges, clear signs that supply is not aggressive. But when a market matures, those pullbacks start showing heavier volume and wider ranges, suggesting that supply is growing. Yet the market may still manage to recover quickly, giving traders the illusion of resilience. But look again, if buyers are forced to expend enormous effort just to reclaim what should have been easy ground, the imbalance grows louder. Have you noticed lately how some dips require massive intervention just to stabilize? That's not strength, it's strain. This tightening imbalance also reveals itself in momentum indicators, even if you don't rely on them directly. Price makes new highs, but momentum makes lower highs. Volume surges upward, but price doesn't keep pace. Trend strength indicators flatten, even though the chart keeps climbing. Wyckoff traders don't depend on indicators, but they understand why these divergences occur. The effort required to maintain the trend no longer produces the same result. As indices approach late stage phases, you'll often see increased choppiness. Markets need more energy, more frantic buying, more volatility, more emotional action to keep moving upward. But those gains become increasingly marginal. The public interprets the noise as excitement. Professionals interpret it as distribution. When a market must fight this hard to rise, the underlying structure is weakening. The composite operator knows the trend is aging, so he begins transitioning from supporting the markup to unloading inventory. And when that happens, every push upward contains hidden selling. Parabolic moves are another red flag. Prices accelerate rapidly, but each new surge demands more effort. Traders pour in, volume booms, volatility spikes. But parabolas always end the same way, with no place for demand to step in once the move exhausts itself. The final stages of a parabola are a perfect example of effort vastly exceeding result. Price keeps rising, but only because effort explodes. And when effort dries up, even for a moment, the result collapses violently. You can also observe this imbalance in the way indices respond to news. In strong trends, bullish news generates big upward responses with little effort. Later in the trend, even excellent news produces muted movement. It takes more and more excitement just to nudge price a bit higher. Meanwhile, negative news begins producing sharper reactions. This asymmetry reveals the market's internal fatigue. If you've seen markets shrug at good news but stumble on bad news, you're witnessing imbalance tightening. Another key feature is the change in leadership. When major indices require fewer stocks to pull the entire market upward, the burden increases. Fewer leaders carrying more weight means more effort is needed, just to maintain the appearance of strength. And when those leaders finally tire, there's no broader support left underneath. This tightening imbalance is not about predicting tops. It's about reading the behavior of supply and demand as expressed through proportion. When effort expands and result shrinks, the tape tells you that demand is no longer dominant. Supply is creeping in, even if price continues to rise. And when that dynamic persists across multiple sessions, sectors, or indices, it signals a market environment where risk quietly increases even as prices still climb. Supply-driven markets like energy and metals are diverging from tech, heavy equities, and this divergence is becoming one of the most important signals traders should be paying attention to right now. When markets begin separating in behavior, it means money is quietly repositioning. It means the logic driving one group of assets no longer aligns with the logic driving another. And whenever you see commodities behaving differently from equities, especially the tech-focused ones, it suggests deeper currents are moving beneath the surface. To understand why this matters, you need to look at what drives each side of the market. Tech, heavy equities are powered by narratives, growth projections, and investor enthusiasm. Their prices often move based on expectations about the future. But commodities like oil, copper, and natural gas move for more grounded reasons: supply, demand, inventory levels, geopolitics, and real-world constraints. When the two groups move in harmony, it usually means the broader economic environment is stable. But when they diverge sharply, it means someone is wrong. Either commodities are mispricing the future, or equities are. Recently, you may have noticed tech stocks climbing aggressively while energy and metals begin to stall or reverse. Or perhaps you've seen the opposite: commodities strengthening while tech starts to wobble. Either version of divergence carries a message. Have you stopped to ask which side of the market reflects reality more accurately? Because historically, commodities tend to be the truth tellers. They respond to physical constraints and real demand, not hope. One of the clearest signs of this divergence shows up in how commodities react to economic pressure. If industrial metals strengthen while tech slows down, it could indicate early signs of inflation or supply shortages. Copper, for example, is often called Dr. Copper because of its ability to forecast economic trends. When copper begins rising steadily, it suggests manufacturing, construction, and global demand are increasing. Yet if tech equities remain weak or overly volatile during the same period, it signals that investor sentiment toward growth is becoming cautious despite real economy demand showing life. On the other hand, when commodities fall sharply while tech surges, it can signal something entirely different: a disconnect between asset speculation and real economic activity. Tech can run on excitement and liquidity much longer than commodities can. But when commodities weaken, especially energy markets, it often means demand is softening. Maybe businesses are pulling back. Maybe consumers are tightening. Maybe supply is loosening or inventory is building. Whatever the reason, the point is that tech stocks might be climbing while the real economy underneath is slowing. Have you ever seen the market rise while real-world conditions feel shaky? That's the power of divergence. Another layer to this is the different types of players participating in these markets. Tech, heavy equities attract retail traders, momentum players, algorithms, and passive funds. Commodities attract producers, industrial buyers, hedgers, and institutional traders who manage physical supply chains. When these groups disagree through their buying and selling behavior, it creates a market tension that can't last forever. One side must eventually concede. The question is which side. In many past cycles, commodities have been early indicators of structural shifts. When oil begins trending upward, while growth stocks plateau, it often signals inflation pressures or geopolitical risks building. When metals rise while equities consolidate, it can indicate demand strengthening globally. Conversely, when commodities weaken significantly while tech keeps climbing, it often signals that equity valuations may be running ahead of fundamental economic reality. These divergences are also tied closely to liquidity conditions. In periods of easy money, tech equities typically thrive as capital flows freely toward growth and speculation. Commodities, however, respond more directly to shifts in real supply and demand. So when liquidity tightens, say through interest, rate increases or credit contraction, tech can begin to wobble while commodities remain supported by tangible constraints. Consider how energy markets behave when supply is constrained. Oil might rise due to geopolitical tension or production cuts, even if tech stocks fall due to corporate earnings or rate concerns. This tells traders that underlying economic pressures are real, even if equity investors remain hesitant or out of sync. You might see energy stocks making quiet, steady advances while tech leaders experience violent swings. That alone should make you question where smart money is positioning itself. This divergence also plays out in volatility. Tech often sees wide swings driven by sentiment, headlines, or earnings reactions. Commodities move with a different rhythm. Sharper spikes when supply shocks hit, smoother trends when fundamentals dominate. When tech becomes chaotic while commodities trend smoothly, it's a sign that the speculative side of the market is losing alignment with the fundamental side. Another important sign is rotation. When money flows out of tech and into commodities, even subtly, it often signals a shift from speculative growth to tangible value. Traders begin prioritizing assets tied to real goods, real production, and real pricing power. Conversely, when money rushes into tech while commodities stall, it can indicate optimism about future innovation without corresponding real economy support. As a trader, recognizing these divergences early is one of your greatest advantages. They tell you where the composite operator may be reallocating capital. They show you which sectors reflect real economic conditions rather than emotional ones. And they help you gauge where the next major trend may emerge. Smart money is rotating quietly out of overextended growth sectors. And if you listen closely to the market's behavior instead of the noise around it, you'll notice this shift happening long before the headlines admit it. Rotation is never loud at the beginning. It is quiet, deliberate, and almost invisible to the untrained eye. But for a Wyckoff trader, this type of subtle transition is one of the clearest signs that a market cycle is aging. And once you understand how professionals move capital, you begin seeing the footprints everywhere. In the early stages of a bull market, smart money accumulates long before the public becomes interested. They buy when prices are dull, when volume is thin, when the story hasn't yet caught the public imagination. Then the markup begins. Prices rise, participation increases, excitement builds. Growth sectors, especially tech, often lead these phases because they represent vision and possibility. But as that markup matures, those same sectors become overextended. They rise too far, too fast, disconnected from their foundations. And that's when smart money begins preparing for transition. The important thing to understand is that distribution never looks like distribution to most traders. Smart money doesn't slam the door. They don't unload everything at once. They rotate quietly, strategically, selling into strength while the public continues buying enthusiastically. It's a psychological dance, and if you've ever wondered why certain growth stocks keep grinding higher even when the fundamentals soften, it's often because professionals are using that optimism to exit gracefully. Have you noticed how some stocks appear strong, yet show no true progress when you measure them carefully? That is usually where rotation begins. One of the earliest clues is a shift in leadership. During healthy uptrends, leading stocks push consistently higher with strong, clean price action. But in late-stage environments, leaders begin to lag. Their rallies shorten, their pullbacks deepen. Breakouts become sloppy instead of decisive. Meanwhile, unrelated sectors, perhaps industrials, commodities, or defensive groups, begin rising steadily, almost quietly. This is smart money moving from areas that are overvalued into areas that still offer genuine opportunity. They don't wait for the peak. They rotate before the peak. Volume tells another part of the story. In the overextended sectors, you often see heavy volume spikes accompanied by very little upside progress. Traders see excitement, professionals see exhaustion. At the same time, sectors receiving rotation show increasing volume on up days and light volume on down days. Classic accumulation signature. When was the last time you examined volume across sectors instead of just across individual stocks? Cross-sector volume analysis often reveals rotation long before price does. Sentiment plays a major role as well. Growth sectors usually attract the most emotional buying. When traders feel behind, they chase what has already moved. They buy what has already gone up rather than looking for where smart money is quietly positioning. This enthusiasm becomes fuel for distribution. Professionals rely on that behavior. They sell their shares to impatient chasers who believe the trend will never end. Yet while all eyes remain glued to the popular sectors, capital is already flowing in different directions. You can often see rotation on a relative strength chart. Overextended sectors begin weakening relative to the broad market, even if they still rise in absolute terms. Meanwhile, undervalued or overlooked sectors start outperforming quietly. This is how the market telegraphs its intentions. But many traders miss it because they're focused only on price instead of context. Price without context is noise. Rotation is context. Look at the behavior of institutional ETFs. When there is a noticeable decline in institutional ownership or decreased inflows into growth, heavy funds, it often means professionals believe those sectors have already delivered their best performance for the cycle. They are moving their capital to where the next opportunity is forming. Retail investors usually notice only after the rotation is nearly complete. Another clear sign of smart money rotation is how growth stocks respond to good news in late stages. In earlier phases, good news propels prices quickly, but when a sector becomes overextended, even strong earnings or optimistic guidance produces muted reactions. Sometimes the stock even sells off after positive news. Why? Because professionals are using the excitement to distribute. If the smartest players sell into good news, shouldn't that make you pause and ask what they see that others don't? Meanwhile, sectors receiving that rotation often respond far more positively to mild or even mediocre news. This tells you where demand is forming. It shows you where professionals believe value exists. These subtle shifts in news reaction often reveal the deeper narrative of capital flow. Watch how the character of pullbacks changes. In overextended growth names, pullbacks become sharper and more volatile. Support levels fail more easily. The energy behind each rally begins to fade. In sectors receiving rotation, pullbacks are shallow, orderly, and quickly bought. They behave like accumulation environments, even while the rest of the market loses momentum. Smart money rotation also reveals itself in fund flows, corporate buybacks, and insider activity. When insiders begin selling heavily in popular growth stocks, it usually signals that valuations have become stretched. But when insiders accumulate shares in quieter sectors, it suggests opportunity. Professionals don't chase late, stage momentum. They position where risk is lower and potential is higher. Ultimately, rotation is one of the most powerful tools you can use to anticipate where the next trend will form. It shows you not just what the market is doing, but where the market is going. And once you learn to read these footprints, quiet but consistent, you no longer need to guess where capital is flowing. You can see it in the tape, in the volume, in the leadership shifts, in the divergence between popular sectors and forgotten ones, and in the psychological imbalance between hope and reality. Commodity basing structures hint at potential reaccumulation phases, and if you've spent time studying Wyckoff methodology, you know that the early signs of a new bull cycle often appear in commodities long before they show up in equities. A basing structure is one of the market's most honest footprints. It reveals the quiet, patient work of strong hands preparing for the next move. It doesn't shout. It doesn't attract crowds. It forms in silence on the left side of the chart, where the public is usually uninterested or discouraged. But for a trader who understands how to read cause and effect, a basing structure can be one of the most powerful signals available. When commodities enter a basing phase, it usually follows a prolonged decline or a sharp liquidation event. Prices fall, fear spikes, and participation dries up. Many traders avoid the chart entirely because it looks dead. But that is exactly why professionals begin to study it more closely. Smart money loves dead markets, markets that aren't being chased, markets that allow accumulation without attention. Have you ever noticed how the best long-term moves start from charts nobody is watching? That's the essence of a proper base. The early part of a basing structure often looks messy. Price swings widen, support gets tested repeatedly, and resistance remains stubborn. On the surface, it seems like nothing is happening, but beneath that chaos, supply is gradually being absorbed. Every time price dips towards support and volume dries up instead of expanding, it reveals a lack of aggressive sellers. And every time price pushes upward slightly with increased ease, it shows emerging demand. This tug of war is the groundwork for a reaccumulation phase. One of the most important features of these basing structures is the drying up of selling pressure. In Wyckoff terms, this shows up as decreased volume on declines, smaller spreads, and tighter reactions. When selling becomes weaker with each test of support, it indicates that the composite operator has absorbed the majority of supply in that zone. Picture a sponge soaking up water. Once saturated, it becomes hard for supply to push price further down. That is exactly how accumulation behaves. You may look at a commodity chart and see weakness, but a trained eye sees the last stages of supply depletion. Another sign is the emergence of higher lows within the base. Even if the overall structure still appears sideways, a subtle shift begins. After repeated attempts to break down, the market refuses to follow through. Sellers try to push price lower, but the decline stalls earlier and earlier. This is not random. It's the composite operator quietly raising his bid as he continues accumulating. Have you noticed how some commodities seem to flatten out before trending? That flattening, those stubborn higher lows, often mark the beginning of a building phase. Volume signatures inside the base provide another layer of information. During reaccumulation, you will often see volume spikes near the lows, but only moderate volume during rallies. That tells you strong hands are buying weakness and not chasing price higher prematurely. Many traders misinterpret this as a lack of bullish momentum, but in Wyckoff logic, it is exactly what you want to see. Strength built quietly is the strongest kind. It means professionals are guiding the market, not emotional buyers. Midway through the base, commodities often perform a shakeout or spring. This is where price briefly breaks down through support, triggering panic selling and forcing weak hands to exit. But the important part is not the breakdown, it's the quick recovery. A true spring pulls price below support only to reclaim it rapidly on strong volume. This move tells you that whatever supply remained has been successfully forced out and absorbed. Springs are often uncomfortable to watch, but they're one of the clearest footprints of accumulation by those who understand what's happening. Sometimes reaccumulation structures form without dramatic springs. Instead, you get a long, quiet period where price compresses tightly into a narrow range. This compression is like a coiling spring. Energy builds slowly as supply dries up. When the eventual breakout occurs, it may look sudden, but the cause has been forming for months. Most traders only notice the breakout candle. Wyckoff traders appreciate the entire base that made the breakout possible. Another useful clue comes from intermarket analysis. When commodities begin basing while equities remain volatile or extended, it often signals a shift in capital preference. Smart money begins preparing for a future in which hard assets gain value due to supply constraints, inflation pressures, or geopolitical risk. This rotation may unfold gradually, but once commodities break out of their bases, they can trend with remarkable strength because they're supported by a long period of accumulation. The psychological aspect of commodity basing is also worth noting. During the base, sentiment is usually low. News headlines are negative. Analysts dismiss the sector. Traders avoid the chart because it looks boring. This emotional environment is precisely what allows strong hands to accumulate efficiently. They require quiet, not excitement. Accumulation rarely happens in markets full of noise. It happens in markets full of doubt. Look at the relationship between basing structures and future markups. The longer the base, the larger the potential move. This is a direct application of Wyckoff's law of cause and effect. A wide, shallow base might generate a moderate trend. A deep, multi-month base might fuel a powerful long-term advance. Have you ever studied a commodity that seemed dormant for ages, only to explode upward with huge momentum? That explosion didn't come from nowhere. It came from the cause built during the base. Another layer to these structures is the presence of sector level or macroeconomic catalysts that may align with accumulation. For example, supply shortages, production cuts, new industrial demand, or geopolitical disruptions can all support the development of a reaccumulation phase. But these catalysts rarely matter unless the chart structure supports them. Strong fundamentals atop weak structure fail. Strong structure atop neutral fundamentals succeeds. That's why Wyckoff traders always study the base before worrying about the story. As commodities complete their basing structures, they often begin to show improved relative strength. They stop falling when equities fall. They begin rising even when broader markets remain uncertain. This decoupling is an early sign of leadership formation. Leadership doesn't start on breakout day. It starts inside the base, long before anyone else pays attention. Understanding commodity bases is ultimately about understanding how major players position themselves for future conditions rather than present ones. These structures hint at reaccumulation because they reveal the market preparing for a transition, storing energy, and absorbing supply in preparation for the next major markup phase.